Good afternoon, everyone. I am Dr.P.Rajendran, coming from Department of Commerce CA. Now we are discussing about income tax. The subject of income tax is important for everyone. It is the revenue of the world. Not only world, in India also. India also, the income tax is the most important. It is a revenue of the every government. See, let us discuss the income tax. One, basic concepts. Basic concepts. Different concepts are used in income tax. First one is meaning of tax. The tax is defined as the compulsory extraction made by the central government from the general public. It is financial charge imposed on individuals or legal entities by the government in pursuant in its legislative authority. See, tax is the compulsory payment to government under the Income Tax Act 1961. The types of tax: direct tax and indirect tax. There are two classifications of taxes. Number one is direct tax and another one is indirect tax. The direct tax is comes under the income tax. Income tax is the example of direct tax. And another one is indirect tax, that is goods and services taxes. Now it is called simply GST, General Excise Duty on Products. It is another one. And customs duty, state excise duty on certain items, securities transaction tax. These are all comes under the indirect tax. GST is the goods and service tax, is combine all the taxes. Now there are in ancient days there are different types of taxes. Now it is called only one tax, that is GST. It is comes under indirect tax. Central excise duty on products, customs duty, like as different types of indirect taxes. Next, sir. See, income tax. Now we are discussing about income tax. Income tax is a tax on income, gains or profits earned by a person, such as individuals and other artificial entities. The income tax was introduced in India for the first time in 1860 by British ruler Sir James Wilson. Sir James Wilson is introduced in 1860 the name of tax. Income tax is a person to pay the tax those who are earning particular assessment year or previous year. Assessment is the procedure by which the income of an assessee is determined by the assessing officer. The assessing officer is collect the income from the assessee and the different heads of the income. These incomes are accumulated in one form of return, that is income tax return. The heads of the income is 5 heads of income. Number one is income from salary. Second one, income from house property. Third one, profits and gains of business or profession. Fourth one, capital gain. And fifth one is the income from other sources. See, income from other sources is simply called as a residual income because these incomes are comes previous 4 heads of the income. So these incomes are determined by the assessing officer in a proper manner, that is assessment. Next, assessee. Section 2 under section 7, assessee means a person by whom any tax or any payment or sum of money payable under the Income Tax Act 1961. Every person is comes under section 2 under section 7. This is an artificial person. Not only artificial person, and also a natural person comes under this head, that is individual. That is an individual. Another one is artificial persons. Artificial persons, companies, firm, and Hindu undivided family, and another any business entities are registered under the act particular head of the income, particular head of the business. For example, Income Tax Act 1961 and in the Indian Companies Act 1956. Nowadays, Indian Companies Act is amended 2013. Any company is registered under the Act 2013 or previous year previous Companies Act 1956 is registered. These are comes under the legal entity. These are also like as a person. And another one, Indian Partnership Act. Indian Partnership Act 1935. Indian partnership is classified in different manner. The two or more persons join together to run the business. That is, run the business to earn a profit. The profit are shared according to their capital or contribution of capital. So that is a profit and that is a income from partnership firm. So these also treated as a person because it is registered under the Act. See, partnership registration is not a compulsory, it is optional, but one thing we can go to registration, we get more benefits from the government side. The government give the subsidiaries to develop the business of in future. That is assessee. And another one is types of assessee. Types of assessee is clearly mentioned 3 cases. Number 1, ordinary assessee, and representative assessee, it is called as a deemed assessee, and third one is assessee in default. Ordinary assessee means it is simple, those who are paid to the government to tax under the Act, Income Tax Act 1961, they are treated as ordinary assessee. He is responsible only his profit or losses. And another one, representative assessee or deemed assessee. Deemed assessee means the assessee is not only responsible for his total income or losses, he is also responsible for other persons' incomes. They are treated as a deemed assessee. And another one is assessee in default. See, assessee in default comes under, say, for example, for generally it is business organizations. The employees' tax is deducted from their salary. This tax is paid to the government by the employer. Sometimes that employer is not paid to the tax to behalf of the employee. He simply says that assessee in default. So next one, assessment year 2000. Assessment year Section 2 under Section 9. See, assessment year means a period of 12 months. It is every year starts from April and ends on 31st March. That is that period of 12 months, that's all. That is an assessment year. And previous year, Section 3, the previous year deals Income Tax Act 1961, Section 3. It is most important of the income tax because the income is earned in the year. It is treated as a previous year. This year's income is assessed to the next assessment year. It is assessment year. The previous year income is taxable for the next assessment year. So it is simply says that financial year. So it is more important for calculation of residential status and another heads of income also. So previous year is important one. It is the income is earned in the year is taxable in the next year. The year in which income is earned is known as previous year. Right. Next, sir. Person. See, person is clearly explained in just before 5 minutes or 10 minutes. The person according to Section 2 under Section 31, the term person, a natural person or a human being of an individual. That's all. The person may be male or female or lunatic includes. It includes lunatic means he is unsounded mind. A person is unsounded mind, so he is called a lunatic. He is called as a person, but he is not act any business relevant related work or business related transactions, but he is a normal person, but something different. And individual, first one, individual, it is natural person. All natural persons are individual. Mr. X, Mr. A, Mr. B, Mr. Subbu, everyone. He comes under an individual. He is earned in something. A person is not earned under 5 heads. It is not compulsory. A person can earn any one of the way. So it is income of an individual. And another thing, he comes under person, that's all. Hindu undivided family, that is simply says that the HUF, it is an ancient business, that is a Hindu undivided family. The Hindu undivided family, family head is known as Karta. He is managed all the business transactions, every business, any business sold or any assets are purchased in a previous year. It is takes place under the head of the Karta. The another persons are all, that is our members, they are collectively told as co-personers. It is comes under person. And a company. A company is an artificial person. It is created by law. It have a perpetual succession and common seal. A person, it is treated as person. A company is registered under any Companies Act. A firm, it is a partnership firm. A partnership firm, partners collectively told as partnership firm. Simply says we can say a person can a partner. Mr. X is joined in our business newly. Already the business is run by 2 persons. Now a person join. One person join, he is termed as a partner, collectively told as partnership firm. So it is comes under person. And an association of person, that is AOP, an association of person. Association of persons are some simply says that TLOP, that is Tiruchengode Lorry Owners Association, OA, right? TLOA, Tiruchengode Lorry Owners Association. It is all comes under the AOP, that is association of person. And another is body of individuals, BOI, body of individuals. And legal not like that, local authority and artificial judicial person, that is comes under universities and other autonomous bodies are all what is called judicial person. So these are collectively comes under person. Next thing, income section 2 under section 24. So income is more important everyone. So if there is no any income, we are not doing anything. Not only in a family, and also a country. So income is important everyone. A person can any money is earned by any activities, that is economic activities. Economic activities are generate only the income. The non-economic activities are also there. So non-economic activities are not generate income. So economic activities, that is income is money that person or a business receives in return for working, providing a product or service or investing capital. It includes profits and gains, dividend, voluntary contributions received by trust. These are all some examples of the income. So there are nearly 100 heads of income we can say, but now we are discuss only 3 heads, that is profits and gains. Profits and gains. Profits means any economic activity is done by anyone, he get a profit. And also like as a gain, it is a slightly difference between professionals are earned in gain. Professionals, engineer and advocate, then doctor, they are called professionalists. They are professionalists earn money in the name of gain. Professional receipts minus professional expenses. The expenses are related to professional related expenses and professional related receipts. These are all the important for calculation of professional gain of the particular professionalists. For example, a doctor, a medical practitioner, doctor and advocate, chartered accountant, they are all comes under the professionalists. Dividend is nothing but it is earned by shares. Any person can invest their money in the company's shares the company to give the reward of the shareholders, that is dividend. That name is dividend. We are invest in Indian company or foreign company shares. It doesn't matter. Any money is dividend. Any money is received from the investment of shares. It is known as, it is said to be dividend. And another one, voluntary contributions received by trust. Voluntary contribution, trust, the trust is giving the services to the society. Any contributions or any sum of money to give to the any trust, it is income of the trust. We are providing in money to trust or some other rich people to provide some money for trust to maintain the trust related services. And another thing, heads of income. See, everyone have a five fingers in our hand. It is like that, everyone to earn money under 5 heads. It is not a compulsory. It is our own interest and own skill that is comes under 5 heads. That is, first one is income from salary. It deals section 15 under 15 to 17. Income Tax Act 1961. Income from house property section 22 to 27. These are all the sections of the Income Tax Act. This particular section deals about the particular head of the income. Income from profits and gains of business or profession, section 28 to 44. Income from capital gains, section 45 to 55. Income from other sources, section 56 to 59. See, income from salary. Let us to discuss every 5 head of the income briefly. First one is income from salary. A person to earn money under the salary. The salary means every organization to provide salary for the employees. The employee join to work first day of the month and end of the day of month, that is 31st or 30th day of the month, we can get money, that is a reward, that is a sum of money is told as a salary for the next month beginning. And another one is income from house property. A person to hold some assets, especially house property, building, these are all let to the some other peoples, let out house and self-occupied house. There are two classifications of the house property. First one is self-occupied and another one is let out house. Let out house is an economic activity. Self-occupied house is non-economic activity. That's all. And another one, income from profits and gains of business or profession. Profits, business income, business, a person to run a simple business, that is buying and selling or trading of the goods, furniture. So furnitures are bought and sold to another persons. That is business. Any income is generated under the business, that is profit. And another one is a gain. The gain is professional persons to earn their skill, their what's that? That is a particular skill. For example, medical practitioner, he is a particular skill. The relevant field of the experience is gained through the education. That is a profession, medical practitioner, doctor, like as doctor. And another one, engineer, chartered accountant, and advocate. They are particular knowledge, particular field of knowledge is gathered through the education. They are using the earn profit of money. The profits and gains of business or profession. Business or profession. Profession means that is professionalists. Professionalists are acting as a particular business profession, that is called profession. For example, doctor. The doctor is getting a degree of MBBS degree that is used for to start the clinic. Chartered accountant, CA, that is a chartered accountant. CA is education. CA education is get from the ICAI, that person can start the business and in the name of profession, that is chartered accountant. And engineer, the different types of engineers, particularly civil engineers, they start the business in the name of construction. That business is that profession to give a gain to that engineers, so they are called a profession. And another one, income from capital gains. The assessee hold a lot of assets. Some assets are connecting a business or not connecting a business. It doesn't matter, but any asset is sold or transfer within 36 months of the previous year, it comes under short term. That is simply says that capital gain. Capital gain means any income is arise at the time of transferring of capital asset. That's all. And another thing is a capital loss. Capital loss, not only we can get a gain. Loss also made by the businessmen in the name of capital loss. Any loss is occur at the time of transferring of capital asset, that is treated as capital loss. That is the capital loss are classified two categories. Number one is short term and long term. Any transaction takes place 36 months, within 36 months, any transaction, that is the asset is sold within the 36 months, that is short term. More than 36 months under the Income Tax Act 1961, it goes to long term. Long term gain and long term loss. Short term gain and short term loss. So it comes under capital gain. Next, income from other sources. The other sources is an residual income. These incomes are not comes in previous 4 gates. In previous 4 gates, that is income from other sources. For example, income from lottery, winning from lotteries, crossword puzzles, horse races, winning from horse races, card games, gambling. These are all the casual incomes. These are casual incomes. These also comes under the other sources. Income from other sources are generally classified 2 heads. Number one is first one is income from specific and income from general. General income and specific income. See, general income and specific income. General income is dividend, interest collect from bank, interest on investments, and interest from any other short term, long term investments. These are all comes under the other sources. And dividend. Dividend is like any amount is invested in a share, that amount is generated income, that is dividend. It is also income from other sources. Indian company dividend, foreign company dividend, all the dividends are taxable. Rates of tax. The rates of tax is the important for calculation of tax liability. Income tax rates applicable to individuals, resident, non-resident, for the financial year 2021 to 2022, assessment year 2022-23. See, assessment year means the current assessment year now. 1st April starts on 1st April and ends on the 31st March 2022-23. It is the assessment year. Previous year 21-22. 21-22, 1st April to 31st March 22. That is 1/4/2021 to 31/3/2022. That is the financial year. The financial year is important to calculation of tax rate liability. Net income range, rate of income tax, these are all clearly given. Individuals, whether males or females, other than senior citizen, super senior citizen, HUF, AOP, BOI, these are all, this slab is applicable. This slab is except senior citizen and super senior citizen, because the beginning of the slab is differ from the senior citizen and super senior citizen. See, individual, first up to rupees 2,50,000, there is no tax, that is tax liability is nil. Next 2,50,000 to 5 lakh, 5% slab. 5 lakh to 10,000, 10 lakh, 5 lakh to 10 lakh, 20%. Above 10 lakh, 30%. Above 10 lakh, 30%. A person can earn money in the previous year or income more than 10 lakh or above 10 lakh, it is goes to 30% slab. So there are 4 slabs. First slab nil, 2,50,000. Second slab 2,50,000 to 5 lakh, 5%. Third slab 5 lakh to 10 lakh, that is 20%. And fourth slab above 10 lakh, that is 30% tax. It is cover only individual. Individual, HUF, AOP and BOI. Senior citizen and super senior citizen. Individuals, senior citizen, the age of 60 years or more but less than 80 years. That is senior citizen. Senior citizen means the age of 60 years or more but less than 80 years. It is important thing. 60 years or less than 80 years. The slab is up to 3 lakh. 3 lakh, there is no tax liability, nil. That is tax liability is nil. 3 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. Above 10 lakh, 30%. See, the government give the benefit that is privilege to the senior citizens, because he is not simply sit in a house, he is not take a rest in the name of old age. He is also act as something. So they are doing some business, or they are develop in our traditional business, anything. So they are comes under senior citizen. The senior citizen slab rate is this. And another one is super senior citizen, the age of 80 years or more. The age of 80 years or more, he is called super senior citizen. His slab is only 3, up to rupees 5 lakh, there is no tax. And rupees 5 lakh to 10 lakh, 20%. Above 10 lakh, 30%. See, 3 slab rates for super senior citizen. It is a privilege to super senior citizen. It is provided by the government. There is no tax liability for up to 5 lakh. See, next is health and education cess. Health and education cess is levied at the rate of 4% on the amount of income tax plus surcharge. There is no surcharge in this case, only health and education cess 4%. First we calculate the tax according to their slab rates. The total tax liability is eligible for health and education cess. For example, total tax liability 70,000. The 70,000 is eligible for health and education cess. The 4% is charged on 70,000. That is health and education cess. It is additional. Dear students, it is now we are discussing about income tax. These are all really very important one to every student. It is a basics. It is a basics of the income tax. I think it is more useful for you.